super long-term trade, but it's definitely one that was very painful at points. And I think that was kind of what we're trying to highlight here, just being mechanical, rolling, reducing position size, or reducing delta, adding positive extrinsic value, maybe adjusting the strikes a little bit, leaning long into down moves, short in top moves. All those things are part of this adjustment. So, just a good one. And it's a high volatility underlying, so that helps as well.
Let's do it.
All right. Jumping into the first page here, we don't have to spend a ton of time on here, but if you have a tastytrade account, you can pull up all these transactions on the tastytrade follow page. So when we get to the first slide here, it'll show you all my transactions from start to finish for this trade, and when you click on it, it'll open up, gives you my little comments on everything. But you can see all the transactions there on the follow page. Cool little feature. Of course, we show it throughout the show as well. Jumping to the next slide 2. So this is my order chains, and you can see I started with the 85 put, sold a call against it, rolled out in time, adjusted the strike, scalped out of the calls, just trading this position into what was a huge move in the stock. And we're going to take a look at that too in a couple slides. But it ended up being basically a scratch. I lost $42 on it overall. A big old nothing burger in my book. After you see the chart, I think we'll explain a lot of why I closed this position when I did. So jumping over to the third slide, just to look at the chart of this position. So I've realized a lot of times, like with these segments, people are like, oh, why didn't you just do nothing or whatever? And so I wanted to zoom out a little bit because the actual adjustment chart, it's still a big move, but I wanted to put some context to it. This is a stock that traded from, let's call it 145 to 100 for the better part of a year. So and that's a big range. It's 40-point range, top to bottom. It's a big range. And I was looking at a put where I sold the put when the stock was somewhere around, 105, 110, kind of the lower end of where it traded in this range. I sold the 85 strike put. So it's probably 20 points out of the money, 20% down move. No big deal for the position, right? Well, you can see over the next month and a half, the stock went from 110 down to $60. So 50% down move. And people always ask about, what do you do in these, what happens if the stock crashes? Well, this is a crash. This is a crash in a single name stock. So we're going to walk through how we got back to a manageable position, basically a scratch on this trade. So keep that in mind. This is a crash type scenario in terms of the management of this position. So jumping to the fourth slide here, we're going to take a look here at the delta of the adjustments versus the underlying price. So on the left side here, you can see the delta of each adjustment. So I started with like 20 deltas long. Every one of my adjustments to the downside are short delta adjustments. So I'm flattening out delta. You can see the stock has gone from 107, 108-ish, down to 80, back up to 90, 90 to 75, 75 to 60, and kind of flatline there. The stock is currently trading not much higher than where we were, 75 right now. So it's had a 50% range in terms of the stock price, going from 110 to 60 in the span of 3 months. Crash type moves.
Yeah.
Now, it's a single name stock, so this is possible. You don't typically see a 50% crash in the market as a whole, but here's how we battle through this.
Yeah, and this lacked a lot of two-sided action. This is basically a straight line down. Straight line down.
Yeah, no bailout. You get, within a month, it was trading at 65, and it's moved nowhere since then. So I was 20 points, 15, 20 points in the money within a matter of weeks.
Yeah.
Which is a big loss. We're talking about $1,000, $2,000, in potential loss on that position had I done nothing and just closed the position.
Yeah.
Jumping over to the fifth slide here. So when we look at implied volatility rank, obviously you can see we started high, 75 IV rank, got up into the 100 handle. I think that was after an earnings or something like that. But it's a perpetually high volatility underlying, as you can see in the IV rank. You can also, if we jump to the 6th slide here, you can see the actual implied volatility of the underlying. You know, we've had 80, 90 implied volatility. We've had all the way down to, you know, 50, 60. So it's one that's had changes in implied volatility, even though you had a down move here. So it started with high implied volatility, stock gets cut in half, and volatility actually contracted in this underlying. So that was one thing that didn't work out in our favor, but it wasn't needed in terms of this position.
Yeah, and even right now with end phase at a 58 IV rank, so kind of on the lower end of, I should say the middle of the range, it still has 80% implied volatility. So
yeah,
still plenty of premium relative to the stock price, which
might have to sell another put here.
There you go.
I mean, you might get me to get back in this.
But yeah, IV rank is always good to look at and understand, so you have context around the actual implied volatility of the product, which is on the right-hand side of the options table. But the actual implied volatility is really what tells you about the option premium relative to the stock price. So as long as we have an actual implied volatility of 50, 60, 70, 80%, I really don't care what the IV rank is, because there's still going to be plenty of premium to sell relative to the notional risk of the stock, which translates into a high return on capital potential, an efficient use of capital, et cetera, et cetera. I would always rather sell premium in a 0 IV rank product that has 60% implied volatility versus a 100 IV rank product that has 15% IV. Because 15% IV tells me nothing. I don't care what the IV rank is. There's nothing to sell.
Well, it tells you the market expects this to go nowhere.
Yeah.
You're not getting paid to risk it going somewhere.
And taking that one step further, if you're in a higher IV product, you have a lot more flexibility when you're rolling from 1 month to the next. You can manipulate that product a lot more easily, where a low IV product, like a 15, 20% IV product, like a TLT, for example, you can't really move your strike. Like you can't buy back Feb, go to March and move it 10 points. It just doesn't, you can't do it because there's no premium to offset your premium in the near term cycle. So just more context around trading actively in higher IV products. It's a lot easier to manipulate your risk.
Well said.
Thank you.
Getting over to the last slide here, then what everybody's been waiting for, the chart of all the adjustments. So you can see I started out with just the naked put. Stock dropped from, 90 to 75, 80-ish. I sold the call against it. Had a little bit of chop there from the end or the middle of October to the end of October-ish or early November. Had a little bit of chop there, which benefited me. I took that position, rolled out in time. I took that position, which we had a huge move, the second huge move from 80 or from 90-ish down to 60, 70-ish. I closed out the call. I just leaned long. So this is something you hear us mention all the time. At a certain point, you have to make the decision to be long or short at a given point, or you have to go inverted or do something else. That decision is up to you. For me, I said, you know what? The stock has gone down 40, 50%. I'm going to lean long here. So I stayed with the put. You had a little bit of a rally back. Stock goes from 60, 65-ish. I saw the call against it. I go inverted on that position. That's kind of your white flag. All right, I'm waiting for a little bit of a directional move, but I want this stock to chop around. I want to take advantage of time decay. All those things work in your favor. From the middle of November up to basically the early December portion, I take that inverted strangle because we had a nice move higher from 60 up to 75-ish. I take that inverted strangle, which is right in the middle of my strikes, buy the guts, sell the wings. So I do that with a roll out in time. So essentially you take your inverted position, you buy in that intrinsic value, and you roll to an out of the money strangle, and you'll see my profit potential and my break even, the amount of width between my strike and break even doesn't change all that much because I'm doing that for basically a scratch. I'm just taking I'm moving where my risk is. When you're buying the guts, selling the wings, you're moving where your risk is. and that's what I did on that adjustment. From there, all we needed was a little bit of sideways action. Remember, we started with the 85 strike short put. The stock's trading at 75 right now, and it was as low as 60 or 50 something. Adjusting those strikes, we're able to lower where our risk is and lower where our strikes are. And when you get a month or two of chop, which is what we got from end of November to basically the end of December, stock stayed wrapped around 70-ish. You capture all that decay, capture all that extrinsic value, and ultimately are able to get back to a scratch on a position that's, $1,500 loser at one point.
Yeah. And all of these charts are very similar when you look at the anatomy of a trade segments that we do. The blue line is where the stock's moving. And really our goal is to make sure that we can move the green dotted lines, which is our break evens, closer to the stock price so that, like Nick said, eventually if you get that sideways action, all of a sudden all of your premium that you've collected thus far kind of comes in that sense. So you just need the stock to behave at some point in time.
Yeah.
And trading small allows you to manipulate the strikes from one month to the next, add a leg here, remove a leg here, like you see here. Like at one point, he just had the short put, then had multiple legs, and was able to manipulate that short put down while still wrapping the break evens around the stock price range. So